Chapter 6, Canadian Securities Course, Tax Retirement Planning. So first of all, how does the Canadian taxation system work? So the tax authorities do not allow you to evade tax. You must pay the tax that is due, but you can avoid tax by different ways. You can contribute to an RRSP, and that is an example of a deduction. Deduction reduces your taxable income. And there are other deduction ways also. Second is you can convert non-deductible expenses into tax-deductible expenditures for certain activities like investments and also business. You can postpone the receipt of income, such as, again, when you put money into an RSP, you can take it out later on in retirement when your income is lower, and then you will pay less taxes. You can split income with other family members when handled properly. There are certain ways you are allowed to do that. You can select investments that provide a better after-tax rate of return. So these activities are allowed. So the federal government collects provincial income taxes also in all of the provinces except for Quebec and Alberta. Quebec has its own income tax on individuals and corporations, and Alberta, which has its own income tax on corporations. The fiscal year is the year that the company will allocate for its accounting year. And due to the nature of particular business, some companies do not use calendar year. They may not use December 31st. They may use, for example, October 30th, etc. For example, a department store finds that December 31st is too early a date to close its book after the Christmas rush, and so it can end on January 31st. It has to decide one date and keep that as their fiscal year. So to calculate income tax for a salaried person, it involves 4 steps. You calculate all the forms of income. For example, let's suppose it's $70,000. Then you minus the deductions. If they've contributed to RSP, let's suppose they contributed $5,000 to RSP. So now we are left with $65,000 of taxable income. Then the tax is calculated on that amount, which is, for example, 35%. And then you minus any tax credits, and then you arrive at the taxes owed. So let's suppose they have $18,900 of tax credits, and then the tax payable will be $8,850. So in this way, the tax payable will vary for each person depending on their deductions and their tax credits. There are different types of income that we said you have to add up. It includes employment income, capital property income, business income, capital gains and losses. So for income tax, person's salary, or other incomes that the person gets, we have to add it all up, and depending on the tax bracket, then the tax is paid. For example, on the first $46,605 of taxable income, the federal tax takes 15%. On the next bracket, it will be 20.5%. Then on the next bracket, it's 26%. So if you get a question on how to calculate the income tax of a person, don't directly do based on whatever their income is. You have to do it step by step. For example, $82,000 income for a client. First, $46,605 is going to be at 15%, and that comes out to be $6,990.75. Then the next amount will be $82,000 minus $46,605. So that amount is $35,395. It will be at 20.5%. which is $7,255.97. Then you add these both up, number 1 and number 2 calculations, and you will come to the tax payable, which is $14,246. But this has not yet, of course, we did not minus any tax credits yet either. So the marginal tax rate refers to the rate of tax to be paid on the next dollar of income earned from any source. So if somebody is suppose at $93,000 of income, then if they earn more than that, their marginal tax rate is going to be 26% for any income they earn over this amount. So taxation of investment income are the forms of revenue that can be generated from mutual funds. If you have any investment income, you can get interest, dividends, or capital gain as income. So we will talk about these three in more detail in the next slides. Interest income, you have to report the interest income from investments like Canada Saving Bonds, GICs, bonds, fixed income have to be reported on an annual accrual basis, meaning whether you get the money or you don't, whether you get the cash or not, you still have to report it to the government and pay taxes on it. And interest income is taxed as a regular income and is not subject to any special tax benefit. It is taxed at the marginal tax rate of the client. Then there are tax is due on the dividend, which we will discuss here in more detail. So the dividend tax credit is from a qualified Canadian company. If you have a dividend from a Canadian company, then you get a special tax treatment. If it is dividend from a US company or any other company outside of Canada, then this does not apply. So for that dividend tax credit, the dividend is grossed up by 38%. And then there's a 15.02% tax credit. So we will do some calculations in the next page about this, but this is how the calculation is done for dividends. And then capital gain, 50% is free of tax. So the other 50% is taxed at the marginal tax rate. So like you mentioned, foreign dividends are taxed as regular income. Let's take a look at this example here. So the income received is suppose $1,000, and $1,000 of interest income is received by the client. And based on this 1,000, it is taxable at their marginal tax rate. In this example, the person's marginal tax rate is 29%, for example. So 29% of 1,000 is $290. The client will pay $290 to the government as taxes on the interest. And so that is what they have to pay. Let's take a look at the capital gains first. $1,000 capital gain, 50% of it is taxable. So $500 taxable at 29%. So 500 into 29% will give you $145. That is the tax they have to pay on that capital gain. For dividends, you have to gross up or increase the amount by 38%. If you calculate what is 38% of $1,000, it comes out to be $380. And you add that to the $1,000. So 1,380 is the grossed up amount. Now this 1,380, you have to calculate what is 29% of that amount, right? And that will give you $400.20. And then you have to calculate the dividend tax credit. This is a discount or a tax credit you will get for the amount, because this money is actually, the dividend is issued by a Canadian company. So there's its dividend tax credit, and that is 15.02% of the gross up amount. So $400 minus the 207 The difference is 192.92. So as you can see, this is the amount that they will pay in taxes for this dividend income of $1,000. So as we can see, with $1,000 of each of these three, we can see that they pay the most taxes for the interest, then for dividend, then for capital gain. It varies, it depends on their marginal tax rate, but in this situation, that is how it is calculated. The tax deductible items are related to investment income. And there are two that we'll talk about: the carrying charges and the borrowed funds. For carrying charges, if you take a loan and invest that money in an investment, the interest you pay on that loan can be deducted in certain situations, and that is called carrying charges. So the interest paid on funds borrowed to earn investment income, so the requirements are that it must be in a non-registered account. And you should earn interest or dividend. The other carrying charge you can also charge is fees for certain investment advice. Fees paid for management, administration, or safe custody of investments also. And accounting fees paid for the recording of investment income. The following charges cannot be deducted from investment income. So if you borrow money and you invest it into an RSP, RESP, disability savings plan, or tax-free savings account, then you would not be able to deduct carrying charges. You cannot deduct administration, counseling, and trustee fees for regular or self-directed registered retirement savings plans, or self-directed registered savings investment plans, or RIF accounts. You cannot deduct fees for advice like financial planning, and you cannot deduct safety deposit box charges. The second aspect is borrowed funds. So interest is tax deductible if the taxpayer has a legal obligation to pay the interest. And the purpose of borrowing the funds is to earn the income. And the income produced from the securities purchased with the borrowed funds is not tax exempt. So then in this situation, the borrowed funds, the interest, can be tax deductible, as we mentioned. So next we'll talk about what are the main pension plans in Canada.